Okay, Joe, you ready?
Yeah, let's kick it off.
All right, good. Well, again, appreciate you being here. My name is Alan Johnson. I'm the Chief Investment Officer at Ladder Capital. You heard Joe Wallen, attorney with Carney, Badley, and Spellman. We have Jay Goyle, I believe, joined us from our CEO and co-founder of Actively Learn. In today's session, we'll kind of go through discuss a little bit more about kind of the fundraising path for options as it relates to revenue-based financing. Hear a little bit from Jay in his story, the growth that they've experienced and how they leveraged Ladder Capital to fuel that growth. Kind of get into some of the mechanics around revenue-based financing, and then leave some time at the end for Q&A.
That's great. Thanks, Alan. And thanks, Jay, for being here and joining us. We're excited to talk with everyone here about what revenue-based financing is. Should we go to the next slide?
Absolutely. So I think probably to kick things off, for many of you on the call, if you've dealt with fundraising, you're aware that there's really a gap for early stage tech companies. You're early on, there's friends, families, angels. Later in the life cycle, if you choose to, there's the venture capital route, which comes with dilution, but they're looking for the big wins. And so companies that kind of fit in the middle there there's really a funding gap for those companies. Banks are focused on large enterprises, VC-backed companies, or those with collateral. So really, it's a difficult stage in a company's life cycle to arrange financing or funding for them. As it relates to Ladder Capital, we've created a solution for early stage tech companies. We utilize revenue-based financing as that vehicle. At a high level, with Ladder Capital, you can access up to $2 million in growth capital. Allows you to really focus on growing your business and not focus on the fundraising process. We do not require any equity dilution nor board representation, so you retain equity and control, and really provide a community of entrepreneurs that are in a similar stage and going through the similar things. The reference before, we kind of fit in between, bank debt and venture capital is kind of where we're compared to, or equity financing. Really, kind of when you think about the high level where Ladder Capital differentiates ourselves, so we do not require any equity dilution. We do not require personal guarantees, do not structure with financial covenants, and do not have any board representation. So when compared to equity, it's very light, and that we're not giving away 20-30% of the company. Compared to bank debt, bank financing, they will implement covenants to restrict the growth of the business, and often put personal guarantee requirements into the facility. Ladder Capital revenue-based financing is a debt product, and so it does need to be repaid, but it differentiates from bank debt in that our payments fluctuate with monthly revenues or monthly net cash receipts. And really a big differentiator is really the speed with which we can provide capital. We are a technology company ourselves, and therefore the infrastructure behind the business allows us to work very quickly, often funding as little as 3 weeks, and follow-on rounds in as little as a week. Whereas compared to the bank side of things, when you're explaining the business, it can take quite some time, as well as it's an antiquated process. And on the other side, the venture capital side can take quite some time in terms of finding the right partner, going through the due diligence, and essentially getting to the final term sheet and closing. For those of you that are not familiar with Ladder Capital, the company was founded in 2010 with a recent focus on technology in 2012. Since that time, we've deployed over 110 million across 250 companies and deployed 425 rounds of financing. We have a pretty strong relationship with the ecosystems as it relates to Intuit and Salesforce, as well as accelerators in Alchemist and 500 startups. So we are embedded in the ecosystem for the early stage tech companies. To give you a little understanding of where we fit in, this page really highlights the life cycle of a company. Often companies are coming to us in that they maybe have raised, received friends and family money, potentially received angel investments, and in often cases maybe a seed investment from a institutional equity investor. But where we really can play well into the life cycle is that we can add that growth capital in that stage from when they might have had a small seed investment or bootstrap their company to whether they're trying to extend to a Series A and increase the valuation and the metrics, or essentially if they want to continue to bootstrap, we can provide the $2 million to provide quite a bit of runway to fuel the growth of the company, so that then it opens up other financing options for them on the other side of that. So Joe, I'll turn it over to you and Jay as it relates to kind of going through open up a discussion on Actively Learn.
Yeah, for sure. Thank you very much, Alan. Jay, we'd love to hear your story, Actively Learn, how it accessed revenue loans and how that helped it, how it helped it grow, and then give us some insight into kind of your view of the process. That'd be really nice.
Yeah, sure. So can you guys hear me okay?
Yes.
Okay. So so when we started the company, we did do, if you look at the previous slide, we did do a friends and family round. And then we had raised about $1 million total with angel money as well after that. And so we raised all the money pre-revenue. We used that money to start generating revenue. We also had some non-dilutive grants from the Gates Foundation and from the National Science Foundation, the SBIR program. So we had about $2.5 million of total capital into the company. But we weren't really reaching to the trajectories needed for a Series A, and we're in K-12, and it's not necessarily the most attractive for investors as well. So, we were at a point where we could basically have been relying just on revenues and this capital to continue to grow, but it wouldn't allow us to grow as fast as we wanted. And so, given the seasonal nature of our business, since we sell to schools, our revenue primarily comes in the summertime, so it's almost like a fundraising event in the summer for us, and then we tend to drain down that capital throughout the year. The lighter capital loan made sense. So we were able to then, during periods of low cash, when sales are really important in February, March timeframe, we took out our first loan. I think it's now 2 or 3 years ago, to basically have extra capital to invest in people until we hit the summertime where we got more of our revenue coming in. And so we have found this has been effective for us. It's allowed us to invest in a couple of things that we wouldn't have otherwise been able to help that growth happen. And so we've done it now 3 years in a row, actually.
That's great. So you came back. So your first loan from Lighter was who knows what it was, the amount, but you come back 2-3 times now and kind of increase that line as the relationship in your business has evolved. Yeah.
So we have it's pretty much the same timeline every year. It's right around January or February where we start seeing, okay, we have another 4 or 5 months before most of our revenue will come in for the following school year. We want to invest in a few more things. And so, yeah, so we did it, I guess 2 years ago, maybe was the first time, then last year, and then we just did one again a couple months ago. So we have found it's been an effective way for us. We're still in that same, where you drew the circle in the previous slide, we're still in that same zone where, we might just be continuing to bootstrap the company in this way going forward. Maybe we'll try to raise a round. Obviously there's always acquisition as a potential option as well. But for us in this stage, it's been very, very helpful.
That's great. And for folks who maybe didn't catch this, so one of the things about the revenue loan that's interesting as compared to a bank loan is that the monthly payment amount is not, it's a percentage of the preceding month's net revenue. And so if your net revenue is seasonal, then you're going to have, during the months where your revenues are not as great, you're not going to be stuck with the same fixed monthly payment that you would be stuck with if you were borrowed money from a bank. Shall we switch to the next slide?
Sure. Yeah, I think it's a good, before we move on to this and how it works, Joe, I'd like just chatting a little bit more with Jay on their facility. I think it's a great example on two fronts. I think when you look at what Jay has done with the business. I mean, on the one hand, right, the educational space is a perfect kind of sector, if you will, or niche that applies very well to revenue-based financing, right? So we see this the same in a GovTech space, in that you have these budgetary times where all of the purchases are made in these very lean periods throughout the year. And so where we're not, given your point about the variable nature of the payments, that the company doesn't get choked out in this lean month. Separate from that, I think, Jay, you've done looking back, the growth that you've experienced over the past 2 years has been tremendous. So kudos to that. I think it's close to 400% growth. I think if you look over that period of time, and really you've done that with a non-dilutive capital source, right? You haven't had to go back to something that's minimum chipping away at your equity each round, right? Is that?
Yeah, no, that's correct. We basically have stuck with the original cap structure that we had after our seed round, and so it has been non-dilutive. And yeah, it's a good point. I mean, we've been basically growing about 2x annually. So over this time period, it was a 2x and then another 2x. So you got your 4x total there. And one thing I guess on the previous slide that was mentioned was how did we evaluate options at that point in time? So we could have, we didn't pursue raising capital that much like we could have, but I think it would have been tough and we wouldn't have gotten necessarily the valuation that we would have wanted. And in terms of lighter, so then it's either do nothing, which was an option for us, frankly. Like we weren't necessarily desperate for cash, but then we thought, at the cost of the capital, we could grow faster and be in a better position, and it was worth the cost of it. So compared to a bank option, I think for us, we wanted the flexibility on payment schedule, meaning paying when the revenue came in, which you just described. So that was important to us. The timing was also important. Like I said, this is kind of like a Jan-Feb decision. And the first time we did it, we're like, oh, if it was going to take an extra 2.5 months, by then it wouldn't have even mattered that much. So we wanted to leverage that time period as well. So the things you had mentioned earlier, I think all of those came to play for us. And one of the things that I've always appreciated is that the people at the company have always been really transparent about the cost of the capital, about comparison, about where the benefits are, about what to consider. Even when I did a little due diligence, there's constantly people calling small businesses to help finance them. You get like robocalls every 2 days offering money. And so even when we did those diligence calls, like everything that the folks at Lighter said turned out to be accurate and true. So it just made me more confident that, okay, I'm going to get what they're saying.
I appreciate that. Hey, there's a little bit of background noise. Joe, can you mute for Ward? Yeah, that's great, Jay. What were you, to give people an idea of what the use of the funds to fuel the growth of Actively Learn? Where did you determine that was the best use of the capital over these? And I think you've taken 3 rounds over the last 2 years, and so as you noted, each of those, early 16 and then 17 and then 18, right? So how has that? Each, I guess, 2 questions. One is like how do you determine that where you're going to put it and the kind of the return on that investment, right?
Yeah, so I would say the first year has been a little different than the last 2. So the first year, I think we probably invested in some marketing initiatives that we might have otherwise not done. For us in education, conferences ends up being a pretty big deal. Also some outbound investments that we might have not otherwise made. The last 2 years has been slightly different, just partly because I kind of know, given our revenue structure and where we're going and where growth, I kind of know this capital is available to us if we need it. So what we've done is we've kind of set ourselves up for potentially needing it around that time. Meaning if we hit some more mid-year deals, maybe we wouldn't, but otherwise it's largely just supporting the entire infrastructure of the company. So, being able to hire from even starting in our revenue time, we'll hire an extra salesperson because we know even if we're not generating that revenue, hey, we can go back and increase the loan size if we need to. So it's almost not just where are we going to put the money in exactly at that point in time. It's I'm planning ahead for, hey, if we need it in 6-7 months, we can get it if we need to, given where we know the trajectory of the business.
Gotcha. Okay. No, that helps. Well, good. No, I appreciate you sharing your experience and how it's been helpful, in terms of scaling the business. And congratulations to you. I mean, as I mentioned, the growth that you guys have experienced over the last 2 years is absolutely amazing, and you guys are well on your way. And the valuation, as you noted, you think about what the valuation would have been early 16 versus where it is today, and the fact that you still own the same amount of the company is awesome, to you and the founders.
Yeah, for sure. Thanks.
Absolutely. Okay. With that, we can open up in the end. If there's any questions specific to Jay, we'll circle back there. But just moving on a little bit, as Jay noted, kind of as evidenced by Jay's story, right? That we've been working together since early 16, and so we do look at ourselves as a long-term capital provider. The facilities that we structure range anywhere from maturity dates of 2 to 5 years. So they aren't necessarily bridge loans. Usually, a perfect example is Actively Learn, and that it allows you to kind of go from that earlier stage to fuel the growth and the valuation over that period of time. We do provide up to $2 million of growth capital, and that's taken over a number of tranches. Again, in Jay's case, they've taken 3 different facilities over the course of the 2 years. And that, each of those is a single facility outstanding at a time. So the other facilities are recapitalized into one, so it makes the payment and the servicing very easy. How we determine how much we can provide is a multiple of monthly revenue. So if a company is doing $100K a month, we can lend anywhere from $300,000 to $400,000 in that initial tranche. As that revenue continues to grow, is where we can continue to add more and more leverage to the company and fuel that growth. How Lighter Capital makes our return is based off of a repayment cap. It's a multiple of the principal balance. So if you qualify for $200,000, and with the repayment cap is called 1.5x, the amount owed to Lighter Capital over that period of time would be $350,000, $200,000 of interest and $150,000 of interest. $200,000 of principal and $150,000 of interest. And it's a risk rated. That repayment cap is based on kind of our algorithm of what is the return we need to get in exchange for the risk profile of the business. How we're repaid that, or how we get our investment back in the principal and interest, is by way of a royalty rate percentage of monthly net cash receipts. So as noted by Jay, in those leaner months, we received less, whereas in those stronger months, we would get a little bit more in terms of the payment amount. And it is a debt facility, and so therefore it does expire. We are not on the cap table. We are on the balance sheet, and once either the repayment cap is reached or the maturity date comes, we are no longer as part of the business. So I've kind of gone through this a little bit more in terms of the Lighter Capital value prop, but no equity dilution, no board representation, no financial covenants, no personal guarantees. Extremely quick in terms of the funding process. And as we've noted, the payment structure is variable in nature and fluctuates with the monthly net cash receipts. As Jay kind of noted, the use of the funds can fluctuate over the life cycle of the business and where you need to put it, whether it's hiring, whether it's marketing efforts. It really depends upon, or even as Jay noted, kind of the planning perspective of being able to kind of fund operations. So, given the structure and the kind of with the repayment cap and the effective cost of capital, really should be utilized for revenue generating purposes. So really growing the business to increase the valuation on your way to whether it's an exit, whether it's equity rounds and so forth. But cleaning up a balance sheet is really not the best use of it. It really should be around driving revenue of the business. So from Lighter Capital's perspective, what we look for, again, these are technology companies that are producing revenue. So as Jay noted, in the pre-revenue stage, it wouldn't have been a good fit, but once the company started generating revenue, we are able to get in relatively early. I think, Jay, in your case, you guys were at $300,000 a year or so when we initially talked, if I'm not mistaken. I could be off there, but in that case, we can get in pretty early. And so, right now, effectively, we want to see a business that is, in fact, growing year over year, gross margins over 50%, given that the royalty rate payment, we want to make sure that there's that room in there to cover the royalty rate, the profitability, that they aren't excessive burning companies. So, a B2C company with hyper burn is not necessarily the greatest thing. Churn is relatively low. It goes back to the predictability of revenue, that there's, you're not losing your customers on a monthly basis, which goes into the sticky long-term contracts. We want to see a diversification of customers. Currently, we are funding companies based in the U.S., and we will subordinate to traditional lenders, so an SVB, Square One, Bridge, Comerica, et cetera. As an example, this is a company that's currently doing $100,000 a month. Their revenue is, 1.2 a year. We determined that the profile of the company is such that we provide them debt on a 5-year note. So in that case, we can provide up to $400,000 in the initial tranche. We determined based on the profile of the company that the return that we need to generate is on a 1.7x repayment cap. So the total amount owed to Lighter Capital would be $680,000, comprised of $400,000 of principal and $280,000 of interest. The royalty rate is, so we break down royalty rates into tiers so as to mitigate early repayment in the event of a business that is growing at hyper rates. Jay, we can kind of get a little bit later, but Jay, maybe you can talk to, I know in some of your structures, we put that in place to where, the royalty rate on the initial, call it in this case, the 1.2 million would be repaid at 7.5%. At the point that the company eclipses the 1.2, then the royalty rate percentage drops to 4%. Jay, can I open it up to you? You guys have that tiered structure, and maybe you can talk to the benefits of it for Actively Learn.
Yeah, so we do have the tiered structure. I think it's good because otherwise, your interest rate just it gets too high if you're growing faster than sort of these rates. So because of the way I think you guys do your loan and your typical table, you're kind of doing you're basing the interest rate on almost like steady state or minor growth. So if you exceed that growth, and if you didn't have the tiers and you pay 7.5% for, up to, let's say the next year you are doing 2.4 million, you end up paying back too much too quickly. And so your interest just gets higher when you compound it. So so I think it's good for us. We've typically gotten to the third tier so far every time we go, and that's only been for the first year. So we typically take advantage of that.
Absolutely, yeah. And I think that's a good point. It's on an annual basis, right? So in a 12-month period, that when you get to the eclipse, it keeps knocking down. And in this case, we have 2 tiers, whereas in some cases we actually, to your point, can put as many as 3 in there to mitigate that. Your point is good, Jay, in terms of the cost of capital. Effectively, if you think about an IRR perspective, right, that if we don't put the tiers in place and we're paid off in 12 months, the effective cost of that capital is extremely expensive. But really, from our perspective, that's not necessarily what we're not trying to get repaid as soon as possible. We're trying to be that long-term capital provider. So by recapitalizing the notes each time you take new money and restructuring the facilities to reflect different royalty rates or repayment caps, I think, and you've experienced that too, Jay, right? In terms of as we relook the facilities, we kind of adjust royalty rates or tiers and so forth, or repayment caps, right, over time.
Yeah, we have typically chosen to do shorter loans, like a 3-year instead of the 5, and so we're on the lower side of the repayment cap. But we've also just been refinancing every year. So it's not like we've paid it all off. We just have been adding to it and then just kind of starting afresh, which has been, yeah, so that's been good. And I think this last time we kind of understood a little bit more about how the repayments work and like you said, the IRR. But yeah, so that's what we've been doing. Yeah,
I think that's a good point. I think the key, right, when you do that initial facility, and let's say it's the $200,000 in principal at a 1.5x repayment, so the 350, that 150,000 is owed if it's taken to term, or paid back. In Jay's case, when you go and refinance that initial amount, which, right, that wasn't 250, but for example, in 250, that you aren't paying the full 150 of the repayment. It's all restructured and a new repayment cap is established. So that full 150 isn't owed each time we refinance, right? It's only refinancing the principal balance and then truing up the facility. So to your point, Jay, it's not as though that each facility you've taken, you've had to repay the full interest amount, right? It's just each time it's recapitalized.
Yeah, exactly.
Joe, with that, I'll kind of turn it back to you. I don't know if you want to go through anything. Joe, if you had any other questions or want to take it back over.
Yeah, well, let's, are we going to go to the subsequent slides and we can rattle through some of the maybe more technical pieces for the lawyers in the crowd?
Absolutely.
Yeah, so we've talked obviously about all these things before, but we're going to go through them again in a little more detail. And then do please, if you have questions, go ahead and hit us with your questions in the question boxes, and we can answer them as they come in. As we talked about, these loans, these revenue loans are sometimes called royalty-based financing because the monthly payment amounts are key, sort of stylized as if it was a royalty payment, a percentage of net revenue the preceding month. Gives you the ability to not be stuck with what you would be stuck with if you borrowed money from a bank, which was one large payment per month amortized, over the term of the loan, which can get pretty uncomfortable for companies that have seasonality or fluctuation. In any event, let's go to the next slide. This is a fairly typical construction of these documents. You have some measurement to apply the royalty rate to, and usually it's sort of all of your cash receipts. However, as a practical matter, some cash receipts you don't get to keep. So, for example, customer returns or things that shipping charges, things that really don't affect your bottom line. Those are typically carved out from the measurement of what's paid on the royalty rate. Let's go to the next slide. Oh yeah, so this is the royalty or the repayment cap. I apologize. The repayment cap. We've talked about this. So this is typically just a function of some multiple of the amount borrowed, and it relates to, and it'd be interesting. Alan, one thing we didn't talk about in great detail when you were talking about Leiter's approach to this is sort of this is just going to be a matter of the lender and the underwriting processes and the rest of the lender's willing to take relative to the loan. So if you go to Leiter, they have a approach which will give you a repayment cap. If you go to other revenue loan funding companies, they probably have different approaches. Alan, I don't know if you want to talk a little bit about how you and how Leiter thinks about this repayment cap and how you come to the amount that you offer to prospective borrowers.
Yeah, absolutely, Joe. Yeah, it's predicated on two factors. The first is the term of the facility. So as Jay noted, they tend to opt for shorter term facilities, and so therefore the repayment cap is on the lower end of that. So the range, typically our range is anywhere from 1.3 to 2x the principal amount. And so and that's again a function of the loan term. So the longer the loan facility, obviously the repayment cap is higher because it's just general longer term. The longer period of time debt is outstanding, the more interest that is paid. But then the other component of it that goes into determining the repayment cap is the risk profile of the business. So we take a look at a number of factors run through our algorithm that essentially returns a targeted IRR for lighter capital. So some of those things they obviously apply to the criteria we discussed earlier, but when you think about what is the risk in terms of what is the size of the company, what is the growth rate, what are their margins, is their customer concentration, are they burning excessively, how many months of runway do they have? You go and you put a lot of these factors together, and then once we get the analysis completed, it's effectively a risk rating, right? To say a company that it checks off all the boxes on a very low risk company, obviously would require a lower return to lighter capital from a risk profile. On the other end, if it's a company that's very, very early in their life cycle, has very few customers, burning a lot, obviously if lighter capital chooses to invest in that company, that is the risk return factor, needs to be taken into account. So in short, it's a combination of the loan term as well as the risk profile of the company.
Thanks, Alan. Hey, Alan, yeah, that answers my question. Alan, how long does it take? Like you said earlier that Lighter will do a loan in somewhere between 3 to 6 weeks. How if someone pops onto the Lighter Capital website and fills out the online form, how quickly could they hear back in terms of like what Lighter might be willing to do, tentatively at least?
Yeah, absolutely. I mean, initially, we'll reach out within 24 hours and make sure that the information provided is correct, and then we push to get them set up with one of our investment team directors. At which point they have a kind of a get to know you call, understand what they're looking for, why do they need the capital, learn a lot about their business. If there's a match there in terms of what the entrepreneur is looking for, as well as the fit with the lighter capital investment thesis. We move into an expanded application process that is very easy to navigate, and then from there, we can just kind of go through collecting information, have APIs with Xero and QuickBooks and everything else, so we can suck in the information quickly and return, run it through the technology and get an answer. So, I mean, we've funded companies in as little as 15 days, total days, not just business days, and so. It really kind of is dependent upon how prepared the entrepreneur is. It's like kind of how prepared are they, how motivated are they, and how available are they, right? We can move as fast as the entrepreneur wants to move, but as we all know, entrepreneurs are so extremely busy, and so prioritizing financing is just one component of 1,000 that they're focused on, and so. If they, have all their ducks in a row and are motivated to move, we can go as fast as they can.
That's great. That's great information. Thanks, Alan. Let's go to the next slide.
Right.
So yeah, this is again a function of kind of desire on the company side. So Jay, I'd be interested in knowing just from your perspective, like when you did you press for the shorter term on your loan, or is that something how did that come to develop with your loan?
Yeah, why did we do 3 years? We ended up doing 3, I think partly because we, how much capital did we need at every time? So the reason you would do a longer term loan, I mean, I guess you could do a longer term loan with the same principal and just pay it back more over time, but then you are increasing your repayment cap. So typically, I think, at least the way that I understood it from the structure of Lighter, is you would do a longer term loan if you wanted more capital up front. And so our capital needs weren't necessarily super high. It also keeps the repayment cap lower. So I think you had a previous slide, like the repayment cap is anywhere from 1.3 to 1.7. And so the shorter term loans tend to go to the 1.3 side and the longer ones go higher. And so we were interested in paying less as a cost of the capital.
I got it. Well. Great. Well, thanks. Yeah. So this just came about as the process. And Alan, I appreciate you describing you've got a quick start process where you can submit some information and get back word typically within 24 hours, and then depending on what transpires with that preliminary request and the information that comes back, and then you go into a more detailed process. But it sounds like Lighter spent a lot of time making sure that the process is not an impediment to funding documents, funding loans. So that's nice to hear.
Yeah, and I can attest to that as well. I think if your business is using software tools like QuickBooks or like, I don't know, whatever, now we're on Salesforce, other CRMs, but a lot of the reports that Lighter needs are just built in. So you're just like, clicking a couple buttons and then sending it their way in Excel docs. So that was nice for sure.
That's great. Let's go to the next slide. So this is a curious thing because you do have monthly payments and Alan, I don't know how much in detail you want to go into this, but we have in the case of Jay's company, a 3-year term note, and then we have some component of each payment is going to be both principal and interest, and then some mathematical formula is going to have to be employed to figure out how to allocate the principal and interest over the term of the loan, and it's a little bit unknown at the front because we have payment amounts which vary based on revenue. So tell us, if you don't mind, Alan, if you could talk a little bit about this, that'd be, I think, good for the crowd.
Yeah, I think, in short, it's effectively if we get principal rather than the interest or the differential between the principal and the interest amount. In this example, the $150,000, it's not collected at the end, right? It is akin to a debt facility or a bank facility where each month it's a composition of principal and interest. The actual percentage, the actual percentages are vary because it depends upon the amount that has been received. So if you kind of think about it's a rather complex structure, and the payment structure, the formula behind the payment is complex, but it really is trying to say depending upon how much we have collected from month to month, that interest in principal allocation will vary. So probably not worth getting into specifics, Joe, but happy to, if people want to talk through it or have more questions about it, I'm happy to have an offline discussion.
Makes good sense. Let's go to the next slide.
Could I add one thing here?
Yeah, please.
Yeah. This was something that I think was important to me, and I think the first time around I kind of understood it, but less so than the second two. And so I think one way for folks to think about this is just to do a simple straight line loan calculation, because I think that's kind of what Lighter does. So if you would take whatever the repayment cap is and figure out what the straight line percentage is, at least that. And then yes, there's going to be variance based on how much revenue and whatnot. But typically what I found is that straight line, then if you match that up with the revenue, the tiers as well, you're going to be making about those types of payments over time. So because the loan is structured such that your monthly, whatever your revenue tier payment is, it allocates to principal and interest like a standard loan. So you're going to be paying more interest upfront and less over time as you make those payments back. Now, yes, that payment is fixed, but it still has that sort of structure.
Yeah, that's a great point.
Yeah, that's a good way to think of it. So you have in this example, $150,000 of interest being paid over 3 years. Roughly, you can kind of estimate perhaps in your mind that that's going to be proportional over the 3-year period. Although it gets a little more complex than that, but it's a facet of these instruments. It's somewhat interesting in terms of tax reporting, things of that nature. Let's go to the next slide. So most lenders will require a security interest in your company's assets to make the loan. This is obviously true of bank loans for certain. It's true of Lighter as well. And this is a pretty standard approach with this type of an instrument. I'm not sure if there's much more to say here, if anyone has any questions about security interest, but I think it's one facet that people should know about. Typically, lenders who are loaning money on a revenue loan basis, they want to make sure they're getting paid the right amounts, and so they'll want access and information reporting so they can determine the right amount of the payment each month. I know that maybe it'd be interesting for the audience, Alan, if you could talk about how this works with Lighter in particular. So each month, like does Lighter with access to the information send the invoice to the borrower, or how does it work mechanically with Lighter in this particular issue?
Yeah, absolutely. So the payment amount is based on, again, the monthly net cash receipts. And so the way that the net cash receipts are determined is by way of taking a look at we have read-only access to the bank accounts, or servicing. We go in and say, okay, what has come in, what has gone out, so what has the company taken in that month. Jay then has the opportunity to contest what those amounts are. So if he went out and raised equity and equity dollars came into the bank account, obviously that's not based on kind of the operational net from net cash receipts, right? That was capital that came in, so he can contest those amounts. And then at the end of that contesting period, the royalty rate is attributed, applied to those amounts, and that's the amount that we collect.
Gotcha.
Yeah, I don't know if you have any thoughts on it, ease of it, or.
Yeah, I mean, I just think it's a pretty it's a fairly easy process. It's very rare, like you have to go through the statements, but it's maybe one or two things, some some return on an item, or like there's some other cash coming in, but it's quick. It's a 5-minute process.
Sounds nice. Let's go to the next slide. So, I mean, this is a typical sort of lender covenant, commercial lender covenant. So, prohibition on additional debt without the lender's consent. Obviously, the lender wants to make sure it doesn't, it gets the deal it expects in terms of the borrower's structure and ownership of its assets, continued ownership of its assets and operation of its business. I'm not sure there's really much to say here on this, or if you have anything to chime in here, Alan or Jay, on this slide.
Yeah, and I mean, it's just no additional debt, typically the biggest one, and continue to operate. They're more, negative covenants than they are, financial covenants. So make sure you stay in the business, don't put debt on it without talking to us, and so forth and so on. Normal course of business.
Yeah, let's go to the next slide. So usually, this is actually our last slide, then we'll go into questions. But you might be curious if you're listening about usury laws, and you might if you're new to this area, you might look at a loan for a $200,000 loan that pays back $350, and you might say, well, gee, that seems over 3 years. You might say, or even 5. You might say, well, that seems to exceed usury rates. What happens in the usury context is some states don't have usury limitations in the commercial context, and that's probably the most common sort of state law formulation of usury laws. They apply in the household context, but not the commercial context. Some states have specific carve-outs in their statute which provide that if you're taking a share of someone's profits of the business, that's actually doesn't count as interest for purposes of usury laws. So this is just one interesting little facet of this area that you might be curious about if you're a borrower, or if you're a lawyer or an accountant, and you're curious about how usury laws play with these or interact with these types of instruments. And I think that brings us to the end of our slides. And so I'm not sure, we've gotten one question in the question box, and it was about whether the presentation would be made available after the call, and I believe the answer to that question is yes. And so we can get this out to people who are interested in seeing it. We'd love to hear if you have any other questions about how these instruments work and how they compare to venture capital or angel investments or other funding opportunities that early stage companies have. I'd love to talk to you about the variances between the approaches. I think Jay's story is a great story, and thanks for sharing it, Jay, because if you had just raised the money from venture capital or angel investors, it sounds to me like it would have been a lot more expensive to you as a founder and in that instance. I don't know if you spent a lot of time, Jay, thinking about that, but it does. Oh, if you instead of taking
partly the expense, I was going to say it's part of the expense, but it's also the amount. So when you're pitching to angels, or like you need to get a bigger amount. So for us, it's like, oh, we need like an extra 200K, like then you can add it to your last round. It's just not that easy. And sometimes when your business is small, when you got like a $500,000 business, like when we started, like 200K is meaningful. And so that's another issue, I think. So beyond just like the terms and raising, it's also the amounts are like, I mean, again, in a month you can get in the capital you might need at the door for 2 or 3 months of operating that can help you out.
Yeah,
I think
that's a great point, Jay.
Yeah, I was going to echo that. I mean, I think the difference, when you compare to equity or you compare to banks, they're trying to put as much. They're not necessarily all that efficient, and so they're trying to put as much money out the door as possible, right? Whether it's a bank trying to put it out because they don't, the process is slow, or equity investors, in terms of the valuation and kind of the negotiation stage, right? So with Lighter, Jay, you mentioned the ability to take, you wanted the 3-year because of the repayment cap and the principal amount, whereas, we're not forcing you and taking a specific amount, right? You can kind of customize what you need at that period of time. And part of that's because that you can come back again, right, in a couple of months and get more if necessary.
Yeah, and the other thing, I mean, and with venture, like, 80, obviously a big chunk is the company's performance, but so much of it is the story and crafting that story and improving it, and, a 10% yes rate, even, all the biggest companies have like their story about how they went to 15, 20, 30 investors and they heard 1 or 2 yeses. So there are times for the business when that's good, but, with Lighter, just like you share the financials, you want to grow the business, so you just say, yes, I want to grow the business, and then it's kind of it's your choice from there. Cost of capital higher than a bank loan, but again, it's quick, and you can just focus on operating the business instead of focusing on churning on decks or writing the story or a bunch of meetings. If that's not going to get you the traction you would need for that round anyway.
Right. And if you only need $200,000, that is a small amount of money. I mean, your seed stage, even your micro VCs won't actually invest, I don't think, in that small of an amount.
Yeah.
Perhaps some will, but it's a very, very small amount for institutional VC.
And even I think our last one was about $500,000, and even that is, again, given where we are, it's just small. So it's just a different story and a different thing you need to be pitching to get the big dollar amount.
Yeah, for sure. Well, maybe the last thing we should go over for the audience, just before we part, since we're not collecting any questions, there was that one great slide, Alan, which just showed what Lighter Capital wanted to see in order to make a loan. Yeah, and I think this is probably a great one last thing to leave with the audience. If you have, if you're a company or you represent companies, you're an accountant or a lawyer, and they're you're working with companies looking for sources of capital, keep in mind Lighter for companies that have these characteristics. It's a nice way for early stage companies, growing early stage companies, to access capital. That's really unique, I think, in the landscape. If you look at all the different ways you can raise money, I think this is a really nice. It's nice to have this out there for founders of companies. If it wasn't available, Jay, presumably you'd have had to go do something, maybe less attractive in the long run. So in any event, thank you for participating in this, everyone.
Yeah, thanks, Joe. Thanks for moderating. Jay, appreciate you taking the time away from your schedule to provide a little light on your experience in Lighter Capital and revenue-based financing.
Yeah,
you're welcome. And I think my name has been on the screen a couple of times with my email, so if folks need to reach out to me or have a couple questions from the founder side, just shoot me a note.
Very much appreciated. Well, thank you, everyone.
Well, with that, we'll end the webinar, and thank you again. Thanks, Joe. Thanks, Jay.
Thanks, everybody.
Bye-bye.